Good afternoon. Good afternoon. It's Monday, the 11th of August. Welcome to another show of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. Hope everyone had a very good, happy National Day weekend and enjoyed the fireworks. It's a little bit of a gloomy Monday today, but I think for the markets, we got several very high profile, large cap upgrades. So something to cheer about. So we're going to be talking a lot about that today. We have a very packed show of a lot of stocks. So please bear with us and keep up with us. The first is on the Singapore banks. They've all reported. Reporting has been mixed, but we have upgraded DBS to a buy, and I'll explain why. SGX has also reported, and we are keeping a buy on the stock, and I'll take you through why we are still very bullish on SGX. Jarek thinks not all is doom and gloom in the tech manufacturing sector, and he's actually upgraded venture to a buy, and he's going to take us through that. On the other hand, Krishna is turning a little bit more bearish on one of the best performers in the market, Sembcorp Industries. He's downgraded the stock. And then we got Genting Singapore's results as well. A little bit soft, but Samuel still staying buy on this. Plus, a marriage made in heaven with Simba buying M1. We got Husseini joining us with the latest take on this transaction that was just announced. Plus, we got some new trading ideas from a chart guy as well. So lots to go through, but let's start with Jarek. Jarek, welcome to the show. Now you've upgraded venture to a buy, and what's driving the change of heart?
Hi, Thilan. Venture released their first half results recently. If you look at their first half numbers, they were actually much better than what we initially expected. It beat our estimates by 23%, and their margins are actually quite maintained quite well at 8.9% as compared to 9% in the first quarter. So we do think that previously we were too pessimistic, and actually the tariff situation they actually went through the tariff situation better than what we initially expected them to go through. And basically, there are a few new MPIs that are also coming up in the third and fourth quarter as well as for the next few years. So we do believe that management is cautiously optimistic of the future and do expect. This year will be a down year, but the next few years could potentially be better. And lastly, if you look at tech valuations across the board like Franken, UMS, AEM, and so on, these guys, the valuation have all gone up to above 16, 17 times PE. And venture now is it's one of the cheaper ones left, and they are the biggest, with close to a 6% yield. And we do think that management has also rewarded shareholders with a special dividend of 0.05 cents, 0.5 cents, actually bring interim dividend to 30 cents. We do think that management will continue to reward shareholders with attractive dividends. So as overall package, we do upgrade to a buy, for venture.
Got it. But what can go wrong with this call? There's still a little bit of uncertainty around the whole semiconductor tariffs and things like that. So what's the downside risk?
Yeah, I think the key thing is whether they can pass on their costs to their customers if the tariff situation worsens. For now, Singapore is still considered a safe haven. So for now, I think they should be okay. But if the tariff situation worsens, especially for venture, then they might lose market share to their US competitors like Flextronics and Plexus, and then that would result them to have actually a lower continued drop in revenue, which would then surely impact their margins because they cannot keep cutting costs every year. They will have to have revenue growth. If not, their margins will not be sustainable. So I think that's one of the key risks that could potentially happen going down the road.
Got it. Okay, thanks, Jarek. So he's upgraded the stock to a buy. You can see a lot more details on this report on our newsletter today. Now let's turn to the banks. Now, second quarter results season's over. OCBC came in line with expectations. UOB actually missed, and DBS beat expectations. So very, very mixed bag. But commonly we saw net interest margins getting squeezed, and general guidance is for continued squeeze going into the second half. OCBC was the most affected with the significant pressure on asset yields and not pricing down their deposit costs fast enough. UOB was the next affected. We did see some offsets coming from their deposit cost pricing. DBS stood out the best given their interest rate hedges, and these actually can provide some downside support for the next 2 to 3 years. Now, if the Fed cuts interest rates, though, there is going to be a lot more downside to NIMs across all three banks. Probably DBS is the least affected. Loan growth is coming in better than expected, with OCBC the most aggressive, especially in Singapore mortgages. However, this is not enough to offset the NIM decline. There seems to be some appetite coming back from companies to increase their credit lines in the second half, but that's not showing up in numbers yet. On fees, we did see expansion across the sector. Wealth was the primary driver, expanding mid 20% or so for both OCBC and DBS. We saw DBS getting the larger share of private bank and mass wealth AUM, partly supported by what they're saying is AI-driven predictive models. UOB trailed with wealth growing below 10%, and this seems to be a significant headwind in terms of their platform, which they have underinvested in. What is concerning is that the synergies that we were expecting from the Citibank transaction is still not really showing through. Management is saying that they're targeting more investments here, but we will have to wait until those things scale. Now, going into asset quality, we saw NPLs largely falling or stable. We also saw credit charges coming off. There seems to be some consensus around management that asset quality will hold despite all this macro uncertainty. In terms of capital returns, OCBC does not seem to be too committed apart from what they have said in the past. And I think this uncertainty will continue at least until the new CEO comes on board. That's 1st of January next year. UOB special dividends will run off at the end of this year, which means that on an absolute basis, dividend per share will fall by about 23% going into 2026, and that's going to hurt yields. DBS stands out with the capital returns commitments all the way till 2027, and management thinks that they have the capacity to raise base dividends over the next 2 years as well. Remember, they have said that they want to raise base dividends by a minimum of 6 cents in the fourth quarter or for every other quarter for 2025 and 2026. Overall, so we don't see a lot of reason to change our neutral call on the banks. From a bottom-up perspective, we like UOB the least and followed by OCBC. We think both are going to deal with slowing operating income from peaked net interest margins, and also and fees are not likely to offset that. So we are keeping holds on both of these stocks. Our top pick is DBS, which we have upgraded to a buy. We think DBS is the NVIDIA of Singapore banks. The bank has reached a scale and level of execution that has created positive self-reinforcing effects, and they have the ability to dominate the verticals that they're in. They're gaining momentum in deploying AI to create real-world impact, particularly when it comes to funding costs as well as liquidity, and they should also benefit from Singapore's safe haven status bank as well. So quite a few things going right for DBS. So despite the very high levels, we are upgrading the stock to a buy, and we think there is still more upside to come. Now, with that, let's turn to Krishna on Sembcorp. Krishna, welcome to the show. Sembcorp's numbers disappointed. Can you first take us through what were the key areas of friction?
Thank you, Thilan. Thank you for having me on the show again. So basically, it was the gas and the related sales where the top line was a bit under pressure and came below the estimates. And that was primarily because of the lower spreads, as well as the lower contribution from Vietnam. Secondly, there was a negative impact from the higher curtailment rates in China. Again, not something to be surprised about, but I think it came above expectations for me. And also that was offset by the increased operational capacity and also the wind resources in India. So basically, it's two factors. One is the lower spread in the gas business and the higher curtailment rates in China.
Okay. Now you've downgraded the stock to a neutral. What's driving this call?
So two combination. First is we do see a downside risk to the core earnings and also the valuation, which we think are at fair levels. So first, let me elaborate on the core earnings. The core earnings we are getting about, if you analyze the first half, we're getting about 900 million to 1 billion. But depending upon how the pricing and policy changes happen in China and Vietnam, and also the economic growth pans out in India, especially from the tariff-related uncertainty, we do see that there is a downside risk to the earnings, or to this core utilities earnings. But then when we look at the valuation, the Sembcorp Industries is trading at about 13 times the core utilities earnings, about 10.5 times of your overall PATMI, which, I mean, it is not expensive, but again, it is not quite cheap as well. So combination of these two is basically driving the downgrade to the whole call.
Got it, got it. But what would you need to see to call this stock a buy again?
So it has to be a combination of the factors, which basically will include the higher core utilities earnings, depending upon how the economic growth pans out and how the policy changes happen. Or it can be some accretive recycling of the capital, which I think management has alluded to, but we need to see that catalyst coming up, or a relatively cheaper entry point. I think some combination of these factors will basically make us relook at the stock again.
Got it. Okay. There's a lot more details on this in our newsletter today. So thank you, Krishna, for that. Now, let me briefly turn to SGX, which reported their full year numbers for 2025 on Friday. They're a June year-ending company. We are maintaining a buy call on SGX with a new target price of $17.67. Now, as I said, the FY25 core earnings did disappoint marginally, and that was largely from their bigger than expected sequential slowdown from their equity derivatives business. And this is partly to do with the high base effect in the first half, and also some of the key themes that were playing out in the second half for SGX's financial year, such as Southeast Asian tariffs uncertainty, could not be played with the menu of products that SGX Derivatives Suite had. Management is not seeing any deterioration in terms of market share of their primary contracts that are on offer, and they're also introducing new products to address some of these emerging themes. The other parts of the business came in actually better than expected, especially the cash equities. We saw trading velocity reach a 12-year high, driving up trading and clearing revenues. We think liquidity rotations into Singapore, a lot of the domestic fundamentals that we have been speaking about in the past, plus the policy reforms should all keep velocity supported at a high level. So we are forecasting FY26. Again, this is a June year end. Average daily volume to hit about 1.5 billion Sing dollars from around 1.3 billion, which was last year's. We also saw delistings hit the lowest since 2015. Management claims there's at least 30 IPOs in the pipeline. We have actually counted about 16 from media reports, and we've already seen 5 deals completed so far. So we are forecasting about 16 IPOs for FY26. So we think the overall earnings momentum will be positive for the medium term. We also like the escalating quarter-cent dividend that they have announced. While it doesn't do a lot in terms of pumping up dividend yield, it at least gives clarity in terms of where the floor is for dividends. We think SGX is not a yield stock, and it hasn't been a yield stock for a while. But at least the current dividend policy signals where the flow of the yield is. So we're going to be focusing more on growth and momentum for this stock. Stock's trading at about 24 times FY26 PE. Not cheap, but similar to where Bursa Malaysia, LSE are trading, but they actually have much slower growth profiles as well. And they're certainly cheaper than Hong Kong Exchange, which is in the high 30s, which has a much higher growth profile. So we're maintaining buy on SGX. Now, switching gears to Genting Singapore, Samuel Yin is keeping a buy on this stock. He can't join us, but I'm getting a little help from Zuan Hao, who's going to take us through this report. So Zuan Hao, welcome to the show. What were some of the key points that Samuel was highlighting on why he is bullish on Genting Singapore and why he's keeping his buy?
Yeah, hi Dylan. So I think he's keeping his buy despite 2Q25 core net profit falling 11% year on year. So this is largely due to an earnings miss from RWS 2.0 related construction works. So it's mainly from the temporary closure of the aquarium and other construction works going on at hand. However, he believes that the near-term earning weakness should be seen as transitory. So the recovery is expected to be around end FY25 as key attractions such as the Singapore Oceanarium and the Weave Mall start to reopen in July. And you can see that the crowds are packing in for the Oceanarium, and followed by the Lawrence Hotel in October. So the expanded capacity should boost VIP and premium mass business, which will aid in the market share recovery and boost this current low of 25% or 25% of VIPs. So as seen in the 2Q25 results, VIP volumes actually grew 5% quarter on quarter, despite the second quarter being a seasonally weak quarter. So furthermore, his long-term EPS forecast remains intact for FY26 to 27, so underpinned by stabilized operations and a higher spend per visitor. So on that note, also in the change of leadership, he believes that the refreshed leadership team under former CFO Lee Shi-ru and a strategic focus on regaining the lost market share should see an attractive entry point for investors. So this structure appeal of Singapore's integrated resorts market supports for our conviction. Hence, he's maintaining his buy on Genting Singapore as we pile on the long-term aspect of this growth.
Got it. Thanks, Zana, for that.
Thank you.
Now, before I talk about Simba and M1, I've got an audience question asking, with the recent rapid run-up in the STI, is the market more sensitive to adverse news, and should we be wary of a correction? I mean, I think, yes, the market has run up quite a bit, but if you look at it from a valuation point of view, the market's still not particularly stretched. For one, if you look at it from a price to earnings point of view, it's still trading below its long-term PE. So we are actually still expecting pretty strong earnings growth. And I think one thing that I have seen through the second quarter result season is we've generally been upgrading earnings as well. So the PE is probably a little bit lower in terms of expectations. Plus, from an earnings yield point of view as well, given how quickly domestic interest rates have fallen, earnings yields are also at a pretty wide margin as well. And versus, say, the US market, the SCI is still trading at a massive discount. So yes, it has run up, but it has run up after 10 years of pretty lackluster performance. And as we have explained before as well, there are significant domestic drivers, external fund rotation drivers, as well as the policy reforms, all lining up to support the market. So if there are pullbacks, and I'm pretty sure there will be, we would look at them as buying opportunities. Now, with that, let me quickly jump to Hussaini. With Simba announcing that they're taking over M1. Hussaini, can you take us through the deal and the wider implications of this to the telco market?
Yeah, sure. So thanks, Tilan, for having me. It came as quite a bit of surprise that Simba with just a 5% market share is acquiring M1 with almost 17% market share. The deal structure is that Simba is acquiring M1 at an EV of 1.4 billion Sing dollars. That translates to around 7.3 times EV to EBITDA. Where startup is trading, it is trading somewhere around 6 times. So that's give you some context on the valuation side. How it will impact, in our view, it will be positive for the industry, because now the combined entity M1 plus Simba will have around 22% market share, and 22% market share, in my view, is quite decent. So I am of the view that they will behave more rationally going forward, rather than the way Simba was behaving, super aggressive. Okay, that's point number one. Second point is that Simba is previously it was a net cash company, so they had a headroom to be more competitive. But going forward, with the M1 acquisition, their net debt to EBITDA will be 4 times, and 4 times, in my view, is quite high. So that will also kind of indicate that there will be a fair bit of competitive rationality. Now, a bit more background about Singapore is that Singapore, because of the presence of 4 players in the market and a bunch of MVNOs, it was hyper competitive. And it's a very small city state, right? So with this consolidation, I'm of the view that there will be more competitive rationality, and I'm of the view that few of those MVNOs, super aggressive MVNOs, could go away over the years. So in my view, this is a positive step towards competitive rationality. Maybe the last point to add over here is that M1 and StarHub operate a singular 5G access network. Okay, so going forward, as M1 and Simba combines, I'm of the view that the Simba 5G spectrum will also be deployed on that singular 5G network. That means more more synergies on the part of network, and because of that, startup as well benefits. So I'm of the view that net it is positive for the industry, and it is also very much positive for startup, given the competitive rationality, some benefits on the network side, and also the fact that startup doesn't have to foot the bill of acquiring M1 or foot the bill for industry consolidation.
Got it. So actually, this might be a blessing in disguise for StarHub as well.
Right. Yeah. And
Good.
startup is down, so I don't think that is justified.
Got it. Thanks, Hussaini. Let's just quickly look at trading ideas from our chart guy. He's got a trading buy on OLAM Group. OLAM's begun a new uptrend from its May 2025 low, and since it has built a new base above it, so he thinks that there could be more upside coming out of OLAM going forward. On the flip side, he's got a technical sell on CHEONG. It's seen a pretty recent bullish run, pushing momentum indicators, particularly the RSI, into the extreme overbought territory. So be a bit more cautious on this stock going forward. Now, looking at events, I hope you signed up for the geopolitical shifts and US tariffs event with the chief economist of NASDAQ, who I'll be hosting on the 13th of August. If you haven't done so, you can do that now with the link with the QR code on screen. I think it will be a very interesting discussion, particularly coming fresh off the heels of all the tariffs that Trump has set and what that means to the US economy as well as to Southeast Asia as well. With that, unfortunately, that's all the time we have today. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.